In this next session, we will welcome James Burrow onto the stage from BMO Canada. James will discuss understanding the magnitude of race to zero. We will hear from our industry-leading Net Zero Signatory Bank, who will discuss the net zero transition from a bank's perspective, explain what it means to be a net zero signatory, how big the net zero transition is, and why it makes sense to pay attention to how much money is being invested in this space. They will help explain how climate change poses financial risk to the global economy, how we are all connected to one another, and the important role that we each play in helping Canada and our global industry move to a net zero economy. James identifies and addresses opportunities to grow sustainable finance products across BMO. His work includes pursuing innovative sustainable financing solutions and aligning enterprise enablers to incentivize transition-driven growth. James joined sustainable finance from the BMO Office of Strategic Management, where he supported the bank's executive committee by developing an updated enterprise climate strategy announced in 2021. Prior to joining BMO, James was a consultant in Boston Consulting Group's London office and a military intelligence officer. It's with great pleasure that I welcome James on.
Yeah, morning, everybody. It's a pleasure to be here in Vancouver. It's a beautiful part of the world. Dare I say, more beautiful than Toronto? I don't know, is that controversial? Yeah, it's a beautiful part of the world, and it's exciting to be in a part of Canada that is doing so much and is really at the forefront of the race to net zero and driving that transition. I think Ben mentioned that, and he was very much on point there. Geneviève has mentioned what my role is. Effectively, I do climate strategy for the bank, and I help think about new ways that we can help our clients accelerate their journeys to net zero. Okay, a little bit about BMO. Probably most of you know who BMO are. We're a big bank. We're the 8th biggest in North America. We're the 5th biggest commercial lender. I won't go into too much more detail on that. What I will say, though, is our bank's kind of founding principles, our purpose, really sit at the core of everything that we do. ESG is not new for us. I think we launched one of the world's first ESG funds in 1984. We've been net zero carbon neutral as an organization in our own operations since 2010. We were the first Canadian bank to be there. And we have a $300 billion commitment to deploy and mobilize capital to sustainable use of proceeds, which we exceeded this year. We're currently tracking at $327 billion of capital deployed towards sustainable use of proceeds. So yeah, so this means a lot to us as a bank. So how do we as a bank see the opportunity, see the race to net zero and see the magnitude? Now, there's kind of 3 boxes on this slide. There's a big blue one at the top, and there's two smaller blue ones at the bottom. And those are really the 3 lenses through which we view the energy transition, the race to net zero. Number 1, the first one is our climate ambition to be our client's lead partner to a net zero world. Now, depending on which survey you look at, North America as a whole, the US and Canada, needs between $1 and $6 trillion of capital a year to finance the energy transition. That's a huge amount of money. That's a mind-boggling amount of money. So there is an enormous economic opportunity, and there is an enormous responsibility for banks to play a meaningful role in financing that transition. That goes without saying. So that's the first piece. The second piece, I think, Geneviève alluded to in her earlier presentation. We are a lead signatory to many of the international conventions and commitments to decarbonize ourselves, our Scope 1 through to Scope 3 emissions. So that includes the Net Zero Banking Alliance, the Net Zero Asset Managers Alliance, Climate Pledge 100, the list goes on. We have made a solid commitment in numerous places to decarbonize ourselves and work to decarbonize our clients ahead of 2050. I think the final piece, and the piece that I would like to kind of go into most detail today on, because I think it's most pertinent to the audience today, is managing our exposure to climate risk. Now, for us, climate risk equals credit risk. Climate risk is part of credit risk. And what is credit risk? Credit risk is the risk that when you lend money to somebody, you won't get paid back. So if banks don't manage their credit risk very well, they're not going to be in business they're not going to be in business for very long. Climate risk is an integral part of credit risk. So we have to manage climate risk very, very well if we are to manage credit risk well, and if we are to stay in business as a major Canadian bank. Two components at a very, very high level to climate risk. There is physical risk and there is transition risk. Now, physical risk are the sets of risks associated directly with the changing climate. So things like floods, wildfires, torrential rainfall, et cetera, et cetera. The climate is changing. We're seeing it all around us. We're seeing extreme weather events, and those have impacts on the assets the banks finance. So that is physical climate risk. It's quite an obvious one. The other major class of climate risk is called transition climate risk. And that's really the risk that the businesses that we are financing will not be viable in 20 years' time because of shifts in the economy, shifts of where demand is, non-compliance with changing regulations, inability to keep pace with technology. It's a very broad basket of risks, but it's very, very material on the financial operations of a company, and therefore very, very important to us. I'll skip back past that slide and come on to this one, because these are essentially the kind of the structure of what I want to talk about in the presentation today. And I'm going to call these the 3 pillars of pressure, because of a bit of alliteration always helps people remember things. And this is where it becomes, I hope, more relevant to the kind of construction and real estate industry, because what I want to outline is what we see as the pressures bearing down on the construction and real estate industry now and over the coming years, and how to deal with them. So the first thing I'd say, though, is all these sources of pressure effectively come from the public and civil society. These are voters, these are NGOs, these are scientists, the people, the opinion formers around climate change and the energy transition. But that translates into these 3 pillars of pressure. Now, number 1, that is bearing down on the commercial real estate industry, is coming from financial institutions. These are banks, these are insurers, these are asset managers who are looking to manage the climate risk that sits within their portfolio. So that's number 1. And we'll come back to some examples of these in a few slides' time. I think pillar number 2 is government and regulators. Now, Ben did a fantastic job earlier of outlining some of the regulation that the federal government is bringing in. But what I would say is it doesn't stop at the federal government. And this is, again, probably reiterating a point that Ben made. Ben is working through all layers of government, from provincial through municipal, to drive regulation down that will decarbonize the built environment. And actually, some of the most interesting regulations, and some of the ones that I want to highlight today, are actually at the municipal level, particularly here in the city of Vancouver. The final kind of pillar of pressure that I want to talk about is from large corporations who are looking to decarbonize their supply chain. Now, Geneviève alluded to it, with her role at Amazon earlier. Amazon is just one very good example of large, enormous companies that are looking to decarbonize their own supply chains, decarbonize their Scope 3 emissions. And if you want to vend real estate services into those organizations, you will need to have a pretty credible plan about how you can support them decarbonize themselves. So I think we're going to come to the first pillar of pressure first, which is kind of banks and financial institutions and how they manage their risks, physical and transition climate risk. So we'll start there. So this is a super busy slide. I kind of regret putting it on here, but let me try and talk you through it, though. But I think the key point here is how physical and transition risks translate into impacts to revenue for real estate operators, impacts to operating costs, and impacts to capital availability. So down the left-hand side of the slide here, you can see physical climate risk and transition climate risk. And in those buckets, you've got things like heat waves, cold waves, droughts, floods, severe storms, wildfires. I mean, it sounds like the apocalypse. You've got all these physical climate risks there. You've also got transition risks, which include policy and regulations, legal liability, technology updates. Now, if I can just pick one kind of tranche as to how this can affect the real estate industry. And we'll actually go into this in the next slide. But as I said, in terms of revenue, floods can impact occupancy, they can impact rental rates. In terms of operating costs, obviously if your building is flooded and you need to renovate that building, that's going to have significant costs. And it's going to have impacts to your capital availability. And you know what, I'm going to go straight to the next slide actually, which is a kind of physical risk flooding example here. So I guess the first thing I will say is there is nothing new about flooding. You might be asking me like, well, why am I talking about flooding? Floods have been around since, I don't know, the biblical flood. They are not a new thing. And real estate operators are aware of floods. So where am I going with this? Well, I think all the science points to that with increasing climate change, floods are going to become more frequent, they're going to become more severe, they're going to become more unpredictable, and they're going to affect areas that haven't been affected before, and they're also going to affect areas that are already at risk more tangibly. So the chart on the left there looks at a bunch of Canadian cities, a bunch of municipalities, and ranks them by how many of their buildings would be flooded under a once-in-a-century flood. Now, Chilliwack, just right down the Fraser Valley from here, is in the unfortunate position of being in the top of the leaderboard there, with about 46% of its buildings being submerged by a once-in-a-century flood. I guess the bad news is, though, that these once-in-a-century floods are not really necessarily once in a century anymore. They are once every 20 years. Maybe they're once every 10 years, and maybe you get 2 years back to back where you have a once-in-a-century flood. So that obviously, the changing nature of that risk, the changing nature of flooding risk, is certainly something that real estate operators, builders, and developers and operators need to be aware of. Why? I mean, it's kind of obvious, really. There's the cost of the damages. There's revenue disruption if you have to pull tenants out. There's inflating cap rates. There's limitations on land for construction. And maybe one thing that people don't think about is the insurability of properties, whether they are properties that are about to be built or whether they are properties that are already built. Now, the Canadian government has said that for properties sitting on floodplains, they will reimburse the owners of those properties in the initial instance where they are currently uninsurable. The Canadian government will back them up. But I think, and people might correct me if I'm wrong here, I think that is a one-time offer. So if you get wiped out by a flood and you're not insured, the Canadian government will come to your rescue once, but they will not do it time and time again. So insurability is another big thing. But from the perspective of banks, from the perspective of financial institutions, coming back to this kind of key message that I said, like climate risk is credit risk to us. And so if you don't manage climate risk in what you're doing, it will become harder and harder to get access to credit. The price of credit, the price of debt will increase, the volume of debt that you can access will decrease, and it may dry up completely because, I don't mean to sound mean here, but banks aren't in the business of lending money where they don't get it back. And physical risk plays into that massively. I guess the final thing I would say on this slide is I don't want to anchor on flooding too much, like this is the only thing we care about. I think I highlighted in the previous slide many of the other examples of physical climate risk. Some of them are obvious, like wildfires, particularly after what we've seen this summer. Maybe some of them are less obvious. But a couple of years ago, we saw temperatures I think hit 42 degrees in Vancouver and 46 degrees in Lytton, BC. So if you're operating a building that is not resilient in temperatures like that, then again, your business model is not particularly strong and you're going to find it hard to get credit. So it's not just all about floods, despite this slide being all about floods. I'm going to talk about a couple of examples of transition risk. This one is going to be from the perspective of banks. I'm going to come on to the regulations in a second, because both kind of the economic element of transition risk and the regulatory elements of transition risk are both examples of that. So I want to focus on the Alberta oil patch here. And I'm going to start with a disclaimer. We do, as a bank, still bank the oil and gas industry. That is part of our strategy. Our strategy is to help them transition to low-carbon lending models. So I'm not throwing spears at our oil and gas clients here. We're trying to help them transition rather than cut off credit to them totally. But what I will say is that the prognosis for the Canadian oil and gas industry is not necessarily particularly fantastic over the next 30 or so years without very, very fundamental changes to its business model. Why? Well, number one, the Canadian government's carbon price, ramping up to $170 a tonne, massively impacts costs of production. It also impacts the cost at which these oil and gas products, hydrocarbon products, can be sold at the pump. So that has upstream impacts on the industry itself. How does that relate to how does that relate to the construction industry? Well, you can see here the chart on the left. I think this is a McKinsey study from a couple of years ago. But what they tried to do was isolate the impact of the carbon tax on the oil and gas industry in Alberta. And that isolated impact alone is estimated to drive between a negative 10 and negative 20% decrease in Alberta's GDP. Now, that's not to say that's going to happen. That isolates for a number of things. There are probably going to be other industries that buck that trend. And you know, I'm not saying Alberta's going to see its GDP shrink by a fifth over 20 years. But irrespective of that, those are big figures. So if you're a builder or developer, if you're a real estate operator with material exposure to the oil and gas industry in Alberta, everything may have looked fairly sunny, you know, since the last boom cycle, since 2014 or whatever, but it's not necessarily going to in the future. And again, it's not to say you divest from supporting oil and gas clients, but it should at least put the thought in your mind of, well, is my portfolio outsized in its exposure to this industry? Do I need to think about expanding, diversifying, and managing that transition risk myself? And again, as a bank, we will look at our borrowers' business models, see where their biggest exposures are, and see how we think that that places them vis-a-vis their ability to pay us debt back. Again, climate risk is credit risk, and if your credit risk is high, the availability of credit, the price of credit will decrease. Okay, so I want to come to the kind of second pillar of pressure as we see it on the commercial real estate industry now. And what I want to do is zoom down from the federal level that we started at earlier today and pick on the city of Vancouver, number one, because it's where we are. Number two, because I think the city of Vancouver itself is really leading in terms of building emissions reporting and intensity regulations, and is setting some pretty ambitious targets. And I really want to highlight this example as well. I was talking to one of our big real estate clients who are based out of Vancouver with national operations, and they weren't aware of these regulations. But they're hitting, these carbon intensity regulations are hitting in 2026. So the extent to which we can help our clients and help people understand that these are coming, I think, is important. Anyway, I'll get into the details. So I think between 2023 and 2025, starting with larger buildings, over 100,000 square feet, moving down to kind of mid-sized buildings at 50,000 square feet and below, the city is implementing mandatory emissions and energy reporting on those real estate operators. So I think that is kicking in for the largest buildings this year. You may say, well, that's fine. That's a little bit of a cost. We need to work out what our carbon emissions are, and we give the city our utility bills, so what? I think the big one here is the 2026 date, because that's the point at which the city of Vancouver is effectively going to set an emissions cap for buildings over 100,000 square feet. I won't go into the details of exactly what the emissions cap is, but effectively any buildings that are exceeding that emissions cap will have to pay a $350 per ton of GHG. They call it a permit. I mean, I would say fine, but they call it an emissions permit to exceed that cap. So if you're $100 above that cap, you're going to have to pay $35,000 a year. If you're $1,000 above $1,000 tons above that cap, that's $350,000 a year. That starts to become a very, very meaningful, line item in your P&L. And what does that mean for developers and operators right now? Well, we're at the tail end of 2023 now. 2026 is not far away. So if you're building a structure that you're planning on topping out and completing in 2026, you should be doing so with a view to these regulations that are going to be in place. You don't want to find you've just built a shiny new building that is already earning you $35,000 or $350,000 in fines. Likewise with existing assets. Energy efficiency retrofits, particularly to large buildings, are very worthwhile to do. They have increasingly strong financial cases, but they take time. They take time to design, they take time to plan, they take time to secure financing for, they take time to execute. So again, I think the message today is 2026 in Vancouver is not far away. Start thinking about what you need to do to comply now, or be prepared to bear the costs to some extent of non-compliance. I'll go through this slide quickly. I don't think we need to go into all the detail of all the separate cities on here, but suffice to say Vancouver is leading the pack, but probably not by very much. Toronto is pretty close behind Vancouver. Montreal are doing their own things. Calgary is also in the mix there. And it's not just the big cities in Canada that at the municipal level are planning these regulations. We talk to the city of Markham. We talk to Ottawa. We talk to we talk to kind of Metro Vancouver as well. All these cities are following suit in implementing these regulations. So I would say they're really going to start biting in the latter half of this decade, and that's going to accelerate into the early 2030s. But again, coming back to my previous point, that's not a long time in construction and real estate. You know, in these multi-million-dollar projects, this is something people need to start thinking about now. The final point to make, in line with what Ben said as well, is federal building codes are changing. Previously, they didn't really incorporate carbon. It was mainly around safety standards and things like that. But now, federal building codes at the federal level, down through the provincial level, are incorporating embodied carbon. So the carbon it takes to produce the steel and concrete that goes into your building, and operational carbon, as in the natural gas that you're burning to heat your building and heat your water. They're starting to incorporate factors such as those into the building code. So again, start thinking about it now. I'll skip past this slide. Maybe we'll share the slides at the end, but it's just more details on the City of Vancouver's plans. But if you're interested in the City of Vancouver, just go to their webpage. It's all outlined very, very clearly there. Okay. I've probably sounded quite bearish over the last few slides, and apologies for that. It's all about, there's all this risk, you need to manage it better, or we're going to cut off the money to you. I mean, that's a caricature, obviously, but I think I want to maybe end on a more positive note by saying that obviously there is risk. We've talked about climate risk, we've talked about the physical components of that and the transition components of that. But what I want to stress here is also the opportunity. We've talked about Amazon having a net zero 2040 commitment. Weirdly, Amazon operate a lot of real estate. We've talked about Walmart having a similar thing. Interestingly, the federal government itself, through its own procurement guidelines as well, are also, the federal government is looking to decarbonize its own operations and is driving decarbonization through its own procurement. So I think the thing I want to stress here is that all these large operators of real estate are looking at retrofits, and they are asking their vendors to build new buildings that are low carbon or net zero ready for them. So that represents a massive opportunity. If you can get into a place where you can help these major, buyers of real estate services decarbonize and reduce their own footprint, and you can do so faster and more compellingly than your competitors, that is a huge opportunity to win an outsized share of a market that we only see growth in. So yeah, there is opportunity there, I think, and that is certainly an element of the picture that we should be considering. And again, that comes back to the credit risk, that comes back to the bank perspective. Your relationship with your bank is going to be a lot easier if your business model is founded on a kind of enduring thesis that addresses the markets of tomorrow rather than the markets of yesterday. So yeah, I just want to stress the opportunity side of this as well as the risk. BMO is looking, I mentioned that BMO is looking to be our client's lead partner in the transition to a net zero world. We're not as far along in terms of the products and services that I would like. I always think we can be doing more, but I guess that's part of my job. But just to give you a sample of a few of the things that we're thinking about to help our real estate construction and operator clients, to pick a few examples here. So we do have an energy efficiency retrofits financing offering. We're able to channel, we're the only bank at the moment that is able to channel Canada Infrastructure Bank's cost of debt, Canada Infrastructure Bank's capital, priced at kind of between 3% and 5% at the moment to our clients to support their retrofit ambitions. That's one thing. Another thing is we recently bought a company called Radical. It's now BMO Radical to offer decarbonisation and advice and planning, carbon credit trading. So we can do that. Of course, we have full service engineering and construction banking, and we also have a building materials recycling program. Being very candid, I don't know if I'll be thanked by this for the bank, but I think we need to do more in the new construction space. I don't think we have anything differentiated there yet where we're able to say to our clients, if you are hitting net zero ready in your building, rather than building just to what the code says today, we can find ways of rewarding you and incentivizing you through that. I think that is the next focus area for us as a bank. We're not there yet, but that is big on my to-do list for 2024. So I think if the clock is right, I'm running up against time here, so I should sum up. with a few takeaways. So I think number one, like the direction of travel is clear across all those three pillars of pressure that I outlined, from banks and financial institutions, through regulators, through large corporates and the federal government. Pressure is beginning to bear down on the commercial real estate industry, and that pressure will only continue to ratchet up through the second half of this decade and into the 2030s. And it will come from multiple angles. So I guess that's the scary part. The less scary part is, yes, this is a risk, and we've talked about the climate risk, physical risk, transition risk, but it's an opportunity. If you can transition your business model in an appropriate fashion towards being low carbon yourself and having a plan to get your clients low carbon, you're going to be in a lot better of a place to serve the economy of tomorrow. So it's an opportunity as well as a risk. And for a moment, to kind of close out here, trying to put myself in the position of builder developers and real estate operators, what would I start doing now? Well, I wouldn't run for the hills and start panicking because of all these risks I've outlined. But what I do think you need to do is start forming a sustainability strategy for your business now, both in terms of your own business operations and in terms of how you're going to service the real estate and construction markets of tomorrow. So what does that mean? I think first and foremost, get familiar with the regulations that are going to apply to you at the provincial level, at the federal level, at the municipal level, because they're hitting sooner than some people might realize. I think on the builder-developer side, and there may be some presentations and materials circulated about this later, but get acquainted with some of the low-carbon technologies that are going to drive the industry of tomorrow. There's low-carbon cement. There's even zero-carbon or carbon-negative cement companies that are out there right now. Some of the technologies are very old. It's the use of mass timber instead of steel. We've been building buildings with wood for thousands of years, and it turns out it's actually kind of a good idea. So acquaint yourself with some of those technologies. Begin to develop plans to either decarbonize the assets that you own or operate. Begin to develop plans to decarbonize your own real estate portfolios. And I guess the approach that I would take to that is to take two overlapping lenses. One is, when do the natural capital improvements on your buildings come up? When is that boiler up for replacement? Don't necessarily replace it tomorrow, but if you do have a boiler or a furnace that needs replaced in 5 years' time, you should probably be doing it with a heat pump or a very, very low carbon technology rather than a like-for-like replacement. So integrate decarbonization into the natural capital planning cycle of your business, but do so in a way that also overlaps the second lens that I want to talk about, which is regulation. So make sure you're compliant and do it in a way that makes financial sense for your business. And then the final piece is try and understand what the markets of tomorrow will look like and position your business to serve those markets. So I think that's it from me. I don't know if we've got time for questions. I don't know if we have any questions. Feel free to grab me after this. Thank you for listening.